Chapter 9, how we record receivables and payables. Our learning objectives here. Number 1, account for uncollectible accounts receivable under the allowance method. Define liabilities, current liabilities, and long-term liabilities. Define and account for clearly determinable, estimated, and contingent liabilities. Account for notes receivable and payable, including calculations. So there's a lot to cover in this video. Accounts receivable. Under the accrual basis of accounting, a merchandise company that extends credit to a customer records revenue when it makes a sale because at this time it was earned, and therefore they realize revenue. Accounts receivable are amounts that customers owe a company for goods sold or services rendered on account. Frequently, these receivables result from credit sales of goods and services are called trade receivables. The matching principle requires that we deduct expenses incurred in producing revenues. Therefore, the allowance method of recording uncollectible accounts adheres to this principle. Uncollectible accounts expense, also called doubtful accounts expense or bad debts expense, is an operating expense that the business incurs when it sells on credit. Okay, so we classify uncollectible expense as selling expenses because it results from credit sales. What we do is we set up a Contra Account to the accounts receivable, which is called the allowance for doubtful accounts. And when somebody is expected to go bad, some debt, then we write it off to that. We debit bad debts expense, notice it's an expense, and we credit the allowance. Now this has a credit balance because it is a Contra Account to accounts receivable. Now the problem is estimating how much at the end of the accounting period would be bad sales. You see, we made credit sales in this accounting period, but we don't know if they go bad until the next accounting period. So at the end of the period, we must make an adjusting entry here. Well, there are two methods. The income statement method is a percentage of sales. From history, we know that 2% of credit sales will not be collected. So whatever our credit sales were that year, we would set up an allowance for that. We would debit a bad debts expense or uncollectible and credit the allowance. Now, to assume that a company's uncollectible accounts were 1%, then that's how we would do it. The other way is the balance sheet method. That is, we take a percentage of receivables. We age the receivables and we take a certain percentage, and we set up the balance and the allowance for doubtful account that way. And this way, though, we look at what was left in the allowance for doubtful account and make the adjusting entry accordingly. Now, when we write them off, as time passes and a firm considers that a customer has gone bad, as soon as Guy Smith, well, what we do is we debit the allowance and we take them out of the accounts receivable. Credit the accounts receivable. Now, current liabilities are liabilities that result from some past transaction or an obligation to pay cash or provide service or deliver goods at a future date. Current liabilities are obligations that are payable within one accounting cycle, and they will be paid out of current assets. Current liabilities fall into three groups. Clearly definable liabilities, no questions asked. There's another type of group, estimated liabilities. That is, there's the existence of a liability is certain, but the amount is not. We do not know exactly how much that liability will be. For example, warranties. That would be an example. If we offer warranties, we know we'll have a liability, but we don't know how much. The third type is contingent liabilities. This means we're uncertain. This could be a pending lawsuit or something like that, that if we lost would impinge on our assets. So therefore, it is a liability. Finally, notes. Notes receivable and notes payable. A note, also called a promissory note, is an unconditional written promise by the borrower to pay a certain amount in the future on a specific date, and it includes interest. On the balance sheet of the lender, a note is a receivable. On the balance sheet of the borrower, it is a payable. Since the note is usually negotiable, the payee may transfer it to another party who then receives payment from the maker. A customer may give a note to a business for an amount due on an accounts receivable. Also, a business may give a note to a supplier in exchange for merchandise to sell or to bank, or an individual for a loan. Thus, a company may have notes receivable or notes payable arising from transactions with customers, suppliers, banks, or individuals. So there you have the accounting for both notes receivable and notes payable.